Hello class, welcome to the second chapter 4 lecture video. We're going to pick up where we left off last time. We were talking about normal costing and estimating the overhead rate in order to apply that to the product cost to determine our cost per unit, which we're going to do in this video, get that cost per unit. And when I started my share here, it took me back all the way to the beginning instead of where I was. Oops. Okay, and everything we were doing in that first video was for a plant-wide overhead rate. We had one rate for the entire plant. Okay. Some companies believe that multiple overhead rates were going to give us more accurate costing information. Okay, maybe we have a couple departments and we have the cutting department and the assembly department, and the cutting uses a lot of machinery. So we could find one rate there based on machine hours, and maybe assembly takes a lot of labor hours. We can estimate our overhead for the assembly department. Okay, and we can put all of the, maybe that's a lot of labor hours. So we're going to estimate that overhead based off of labor hours. So we can have multiple rates applying at different parts of the job. Okay, it's the same process. To find the department overhead rate, you take the estimated department overhead, still it's that estimated total, divided by the estimated activity level or the estimated base. Okay, this is going to allow us to be a little bit more accurate with our costing. So here we have estimated in the machining and assembling department. Okay, we have direct labor hours in both, and we only have machine hours in the machining department, and we have our cost. We use departmental overhead rates, and the machining department is applied on the basis of machine hours. So to find that, all right, calculate the predetermined overhead rates. Okay, so for the machining department, we go back to the very first slide, slide number 1, where we had all of our estimates. Okay, slide number 1 here of example 4.3. It gave us that $240,000 was the machining department cost, and they estimated 2,000 machine hours. So we are going to apply overhead at $1.20 per machine hour. In the assembly department, our estimated cost was divided by our base, which was direct labor hours, or $1.50 per labor hour. And then when we applied it, it's the same process, only we have to apply it twice. So in June, we had $1.20 per machine hour multiplied by the 17,000 machine hours used, and $1.50 per labor hour multiplied by the actual 20,000 hours used, which was found here, 17,000 and 20,000 in this. At this point, we don't need to worry about the actual costs. Okay. We don't worry about the actual costs to the very end when we figure out if it was under or over applied. Okay, so we applied 20,400 to the machining department. The actual cost was given to us at 22,500. That means what? It was under applied. We also under applied in the assembly department. Applied 30,000. The actual cost was 750 for a total of 2,850 under applied. We under applied it. Remember, when we adjusted it, increased our cost of goods sold. Okay. The whole point of this, of doing this job costing, is in order to get a total job cost and then get a per unit cost for what we completed in the job, so we know what to set our prices at. Okay, so our unit cost is going to be our total product cost divided by our number of units. Just again, drive this home, those product costs are that direct materials, direct labor, and your manufacturing overhead. We've been talking a lot about the overhead, but don't forget the materials. A job order cost sheet is going to keep track of all of this, okay? That's all it is just a sheet where it has the job name, when it was started, when it was completed, then it lists direct materials. They used 1,000, came off their requisition sheets. Direct labor, 1,080 came off the time cards. Applied overhead, that is what we've been doing, however they decided to apply it. But it's the applied, not the actual. The applied goes onto your job cost sheet. Okay, divided by the number of units that was produced in the job, you get a unit cost, and now we can set our prices from there. This is kind of showing how the job flow of costs go through. Another example of the job cost sheet here. We have two jobs. We have briefcases and backpacks, okay? So you can see our raw materials. We had 0, we purchased 2,500, 1,500 was requisitioned out. 1,000 of it went to the backpacks, 500 of it went here. And we have our units that we were producing. We have not applied any labor or overhead yet. When we get our little wage sheet in here, okay, direct labor hours, 60 for backpacks, 25 for briefcases. They all got paid 18 bucks an hour, so our total is 15.30. But we know what, if we take the 60 times the 18 for backpacks, we can find out 1,080 of the direct labor went into backpacks, 450 went into briefcases. For our overhead, they are using a wide rate, okay, based on labor hours. Okay, it gives you all the information you needed. They estimated their cost at 9,600. They estimated labor hours is 2,400. To get $4 per direct labor hour. So then you'd have to think back. Direct labor hours were 85. Okay, times 4, so 340. But you have to remember back to this slide that the direct labor hours for backpacks were 60, and for briefcases they were 25. So 60 times 4 will get us 240 for the applied overhead here, and the remaining goes over here. Here we're given what our actual overhead is 415, so you can see that we under applied it, but we are going to make that adjustment again at the end. It does not change what goes into our work in process account for this. Here we get a unit. Okay, the briefcases are not done yet, so that's why we don't have a unit cost for them. We have a unit cost here for the backpacks that were completed. And it's just showing you this is still in the work in process inventory. This went into the finished goods inventory. And then our schedule of cost of goods manufactured, kind of a review of what we went through in chapter 2. Then we start with our raw materials, find out how much we used, plus our direct labor, plus our overhead. Here we make that adjustment for the under applied, over applied. Here we were under applied, okay. Finally get to our cost of goods manufactured. After that, we can make our cost of goods sold statement. Notice that is where we are taking care of our under applied overhead right there again. It's increasing our cost of goods sold. All right, and finally, last thing I want to talk about here is some journal entries to show how these flow of costs come in. Remember, we are using our raw materials, our work in process, and our finished goods inventory accounts. So how are all these costs kind of flowing through? Okay. First thing, well, the company needs to buy materials. So when they buy materials, whether they are direct materials or indirect materials, does not matter, and it's all going to get debited into a raw materials account. Okay. I wish when they made these journal entries, the second one, they should have indented it more for the credit entry. But we're going to credit in accounts payable here, okay? Because we purchased raw materials, and now we owe them for it. So now one of the jobs that was out there, they requisitioned materials to start producing something, okay? So $1,500 of whatever the materials are. Whenever materials are started being used, that's when it gets moved into the work in process inventory. So we would debit our work in process here, and we would do a credit to the raw materials that's coming out. This is for our direct materials. So direct materials cause the work in process to increase. We have some direct labor being done on this product too, okay? 1,530 was the cost. Whenever labor gets added to a product, it also goes into the work in progress inventory, the WIP. Okay, we do that by debiting it. Okay, and we're going to credit here wages payable because we need to pay their salary. Maybe they got paid that day too. Maybe that could be a cash entry. We just know we owe, that is the labor that's actually getting paid to the workers. Okay, so far we have our direct materials and our direct labor have been added into this work in process account. Okay, applied overhead production at the rate of $4 per direct labor hour, a total of 85 per labor hours were worked. So now we are applying our overhead. When we apply the overhead, again, it is a debit to our work in process, that WIP account. Okay, all of these, the direct materials, the direct labor, and the applied overhead, okay, go into work in process. With the overhead, we're going to credit here, it's called, they're calling it overhead control. Some books call it just factory overhead, it may be called manufacturing overhead. But this overhead control account is just kind of a holding account, as you're going to see, and that's the account we're going to have to reconcile at the end when they don't match up. Okay, but whenever we apply it, we're going to do a credit to that overhead control. Whereas when actual costs come in, okay, we're going to debit that overhead control and then credit whatever the appropriate payable is. Okay. As you can see here, we have a lease, utilities, wages. We are not making it an expense like we have done in the past. Okay, because all of these expenses basically, or these costs, are product costs, so they have to become part of the product. We are putting it in this overhead control. Okay, and you got to remember in the previous slide, whenever we estimate our overhead and we put it into the products into the work in process inventory account, we are crediting that overhead control. All right, so we completed the backpack job and transferred it to finished goods. So we would debit our finished goods by the cost that we calculated, credit our work in process. And then it says we sold the backpacks at cost plus 50%. Okay, so we take that 2320, multiply it by 1.5 or 150%. That's 100% of the cost plus 50% profit. And you'll see that they sold all the backpacks for $3,480. A debit to accounts receivable because they're of that, credit to sales revenue. Whenever you're making a sales journal entry, it's a dual entry. Okay, I would put them the different way, but they're emphasizing that the cost of goods sold gets debited for the entire cost because they sold the whole backpack job, and it comes out with a credit to finished goods inventory. Now, finally, we have that overhead control account. Okay, when we applied it and when we had the actual cost go into it, you would see that we had $75 more in actual cost. So that overhead control was $75 debit balance at this point in time. At the end of the period, we need to make that control account go away. This is that over applied, under applied overhead. In this case, it was under applied. To make it go away with a credit, we have to debit our cost of goods sold, which is increasing that cost of goods sold. So that just reinforces that idea that under applied overhead increases your cost of goods sold. Okay. And then all of those can get plugged into your T accounts, and you can find the ending balance in your work in process or your finished goods, what your ending cost of goods sold were, all that by doing a simple T account analysis based off your journal entries. And that is it for chapter 4. Okay, that should be able to get you through your homework. Okay, it's coming up due soon, and you have one more video for these chapters. You have just one handout for chapters 3 and 4. I think it has 3 or 4 problems on it. Watch that video if you have anything that's confusing you. If you feel like you got a pretty good grasp on it, try to do that handout before you watch the video and just check your answers. I'll talk to you again soon.